Hello students, I hope you all are keeping good. So today we're going to start the chapter Accounting for Goods and Services Tax GST. Now before we learn the practical problem or accounting for this chapter, let us learn the theory for this chapter. Meaning of GST. Goods and Services Tax GST is an indirect tax levied at prescribed rate on every supply of goods and services except on petroleum and alcohol for human consumption. Supply of goods means sale of goods and supply of services means rendering of services. It is a nationwide tax seeking to unify several indirect taxes and is based on the principle of one nation, one tax. Now, to understand this in simpler way, we have got tax as the earning for the government. This is the source of revenue or earning for the government, and the tax is divided into two, direct and indirect. So direct tax is the tax which is the levy and the burden falls on the same person. Like the tax is levied on the person, the burden will also be on that same person, like income tax, wealth tax, inheritance tax. The other type of tax is indirect tax. So the indirect tax is the levy is on different person and burden can fall on different person. Like when you go to the restaurant and or when you buy something from the shop, the shopkeeper or the seller will charge GST or will charge tax which is been levied on or imposed on him from the customer. So burden falls on the customer indirectly. So that is what is indirect tax. The burden is on the other person and the levy is on the other person. Now here this GST has unified several indirect tax, which means that GST has removed the several indirect taxes, like we have excise duty, service tax, central sales tax, and it has merged into one tax as GST. Now at every stage of production and buying and selling of goods from the wholesaler to the retailer, there were taxes which had to be paid. Like here example is given: excise duty, service tax, import duty, VAT. VAT is one of the most common tax which had to be paid on every stages. So this has been unified and made into one tax as GST, and this is based on the principle of one nation, one tax. Now this tax, this tax GST Act, it was passed in Parliament on 24th March 2017 and it came into effect from 1st July 2017. So GST, simply we can say that GST has removed several indirect taxes and made it as one tax, merge or joined it as one tax system, which is called as GST. Now the GST is paid on the supply of goods. Now supply of goods for the commercial or for the business purpose. Now GST is paid on the sale of goods and supply of services, which means rendering of services. So either it can be goods which you are selling. So according to the definition, supply of goods can also be called as sale of goods, and so the GST is been charged on the sale of goods or the supply of services or rendering of services. Now further we will learn about the input and the output GST. Input GST when do we have to, when it is charged, and output GST when it is charged. Now here you can see that state level taxes have merged GST as under. So further we will see the different types of tax GST which has to be paid. So here the first one here you can see is your octroi and entry tax, purchase tax, entertainment tax, VAT, luxury tax, tax on lottery has merged into one tax which is called as state level taxes. All the types of taxes have merged into the one state tax which is called as GST. GST rate structure. Now the goods and services are divided into 5 slabs. For essential items including food, there is 0% GST to be charged. For common use items, 5%. For standard rate, 12%. For maximum goods and all services, standard rate 18%. For luxury items and tobacco, 28%. So these are the different slabs, or the goods and services are divided into 5 slabs for the collection of taxes. So the commodity, whichever group it will belong to, the tax rate will be charged according to that. GST is paid on purchase of goods and services and is collected from customers on sales of goods and services. GST paid, termed as input GST, is set off against GST collected, termed as output GST. Now let us take one example. Now suppose you have a manufacturing unit which manufactures, let us say, computer. Now to manufacture these computers you have purchased some machineries and some raw materials. So when you purchase these machineries and raw materials, what you have done, the company who has sold you these, now you have purchased it, but they have charged you GST in the invoice. So when they have charged you GST, you have paid them GST. Suppose you have bought a machine for 1 lakh rupees and the GST is 18%, so you paid total 1,18,000. So 18,000 was your GST. Now that 18,000 is on your purchase. So this is your input GST. So input GST is paid at the time of purchase. Then here it says that it is set off against GST collected. Now the GST which you had already paid in the time of purchase, you have booked it. You have booked the credit. Now the credit can be booked only if you are registered under GST. Simply anybody cannot book it. You have to register under the GST Act. So you have booked it. Now further let us go. You have manufactured the computer, the laptop, and so earlier you had paid a tax of 18,000 to the seller who sold you the machine or the raw material for making the laptop. So that 18,000 has already been paid to the government. Now further you sold that laptop what you have manufactured for, let us say you have sold it for 2 lakhs rupees. Now when you sold it for 2 lakhs rupees and then you charge some GST, again 18%. Let us take the example that the slabs or the rate of GST is constant, so you charged 18%, so that is coming to 36,000. So you got from the customer 2 lakh 36,000. In the 2 lakh was the cost of selling plus your GST. Now you already booked 18,000 earlier because you had paid to the supplier of the raw machine 18,000. So when you go to pay the amount to the government on the sale of the goods, it will be set off against the output GST, which means the government will say that okay, since you have registered yourself under the GST, you have already booked the input tax credit. You have already booked the tax credit 18,000. What you do is you pay only 18,000. So here happens when the output is more than the input. You already have booked your input when you purchase the material and the machine from the supplier to make this product. You already have paid to the supplier, and the supplier has already paid to the government. So in the process of this, now you are charging 36,000. So already 18,000 is paid. So this 18,000 is been already booked. So you have to pay only remaining 18,000 out of 36,000. Okay, so this is what is said, that GST is paid on purchase of goods and services and is collected from the customer of the sale of goods and services. GST paid on the purchase, which is input GST, is set off against the output GST on the sale of goods and services. As such, GST paid on purchase, input GST, is not cost for the purchaser, but it is an asset. Now, according to the nominal account, we will say that purchase is an expense. So if we are including the input GST with the purchase, so this also will be the expense. But actually input GST on the purchase is not cost or expense. Why? Because you can set off whatever you have paid at the time of purchase will be set off at the time of against the GST collected. Okay, now here one thing is there, that it cannot be reduced. Okay, they cannot say that okay, it will not be reduced, there will be only set off against the GST. So we cannot say that this is a cost, but the input GST is your asset because you can set off against GST collected on sales. Like you can recover back or get back your GST amount. So this is not a cost, it is an asset. Then again it says that GST collected on sales, output GST, is not an income, but it is a liability. So when the seller is getting the GST on the sale, this is not the income of the seller, this is the liability of the seller, because this GST after calculation has to be paid to the government. They owe to the government after the calculation of the input GST and output GST. They are liable to pay to the government. So this is not an income. Next, some important notes. Usually GST paid on purchase of goods and services, that is input GST, is not a cost for purchaser, but it is an asset because it can be set off against GST collected. Like we have already said earlier that it is not a cost, it is an asset because it can be set off against the input can be set off against the output GST. However, in certain cases, GST cannot be set off against GST collected. In such cases, GST paid on purchase of goods and services is cost. Now, in the case where you can set off the GST, it becomes your asset, you earn it back. But in certain cases where you cannot set off the GST, it will become your cost for the purchaser. Following are the cases where GST paid on purchase of goods and services cannot be set off. Food and beverages expense for the restaurant bills. Now, when you go to eat in and pay bill, so these kinds of GST cannot be set off because you are the ultimate one who is purchasing. Payment of health insurance. So when you are paying for the health insurance, or when you're applying for when you have got a health insurance, you cannot set off the GST because further than you, there is no one to sell the goods. You are the ultimate purchaser. Payment of membership of club fee, fitness center, repair and maintenance of building, purchase of vehicle, free gift to staff, payment of goods and services for personal use. So all these types of services or the purchase of goods, which the example is given here, you cannot set off the GST because at the time of purchase of such goods and services, it is only a cost and you cannot set off. Like further, there is no one to purchase those goods. Further, there is no one you can sell those goods. You can simply remember by this way. Anything you cannot further sell it will not have any set off against the GST collected. GST paid is reversed credited in the following cases. Now when we will do the practical problem, there is input GST. Now this input GST, it is paid on the purchase of the goods, or when the goods are or when there is any expenses that is paid on the goods like advertisement, rent. So all these kinds of expenses that we bear, purchase expenses on rent, on advertisement, we pay input GST. So in that case, the input GSTs are debited. Now when we reverse it, we will not change the input as output because that will not become as sale. So all those debited input GSTs will be credited. Like we have purchase, return, we have goods taken by the proprietor, goods lost or stolen, goods destroyed or become not saleable, written off, goods distributed as free sample, goods given away as gift or charity. Similarly, the output GST reversed will be debited in the case of sales return. Like when we are selling, we will credit the output GST. But when there is a sales return, this is not a purchase, this is a return. So that output GST which was been credited will be reversed as debited. We will understand this point number 3, all these 3, when we come to the journal entries for such kinds of questions. Now, following goods and services are exempted from the levy of GST. GST cannot be charged on payment of wages and salaries, supply of service to the government or to the embassies of other country, electricity and water bills, educational services, health services, traveling expense and interest. So the following goods and services are exempted from the levy of GST. So when we do the journal entries, we have to keep in note that wages and salary, supply of service to the government, electricity and water bill, educational service, health, traveling expenses and interest will not be charged with the GST. Okay, but in some cases interest received, there is a GST in that. Characteristics of goods and services tax GST. Point number 1. GST is a comprehensive indirect tax. GST is a comprehensive indirect tax which has replaced all indirect taxes levied by the central and the state government except custom duty, electricity, taxes on petroleum, taxes on alcoholic drinks and taxes levied by the local bodies. All indirect taxes have been merged into single tax, that is GST. So GST has replaced all the indirect tax and merged it into one single tax, that is GST. As one single tax, that is GST. Uniform GST rates. There are uniform GST rates across all states and union territories. Now, it cannot be that different state has got different and different state has got different GST. There is a uniform GST rate all over the other states and the union territories. Number 3, GST paid is not a cost. GST paid on purchase of goods and services termed as input GST is not cost for the purchaser, but it is an asset because it can be set off against GST collected termed as output GST. So I have already explained this, that it is not a cost because you can set off or you can collect it against the output GST and so it becomes your asset. GST is value added tax. GST is value added tax because GST paid is set off against GST collected. For example, A purchases goods for 1 lakh and sells the same to B for 1,50,000 and GST rate is 12% in such case. GST paid by A on purchase, so 12% of 1 lakh is 12,000. GST collected by A from B on sale. So here A purchases goods for 1 lakh and sells to B for 1,50,000. So GST collected by A from B. So when A is selling to B for 1,50,000, he is collecting a GST of 18,000, that is 12% on 50,000. Now GST that will be payable by A to the government will be 6,000, which I had explained earlier with the laptop example. Rupees 12,000 paid at the time of purchase is set off against 18,000 collected at the time of sale, and the balance 6,000 is payable to the government. Further, suppose the above mentioned goods are again sold by B to C for 1,60,000, the amount payable to the government by B will be 12% on 10,000. The amount payable to the government by B will be 12% on 10,000. Now here, if you note that GST is not paid on 1,60,000. After deducting this 1,50,000 from B, A had collected 1,50,000. So when B further gives it to C for 1,60,000, the tax that will be payable to the government by B will not be on 1,50,000. It will be on the difference. 1,60,000 minus 1,50,000, that is 12% of 10,000. So this is what is the step of charging GST. It is only on the add-ons. It is not on the original rate. Objectives and advantages of GST. First one, the first advantage is decrease in the cost of goods. The cost of goods will decrease since tax on tax is eliminated in GST regime. In the pre-GST regime, there were many indirect taxes levied by both central and state. For example, central charged excise duty on goods manufactured and state charged VAT on the same goods. This led to tax on tax, also known as cascading effect of taxes. GST avoids these cascading effects on tax and is calculated only on the value added at each stage of transfer of ownership. Now, tax on tax, which is also known as cascading effect of taxes. Now, what is cascading effect of taxes? Cascading effect of taxes is you have made goods for 100 rupees and adding 10% profit, you have sold it to the wholesaler. The manufacturer has sold to the wholesaler. So the wholesaler pays the tax on 110 rupees. So further, adding the tax to 110 rupees, whatever total is coming, the retailer has to pay on the whole amount that has been charged by the wholesaler, 110 plus G plus the tax. Then again, when it goes to the consumer, 110 plus tax, for example, let us say 110 plus tax, let us say 10 rupees more tax. So on 120 rupees, the consumer has to pay tax. So this cascading effect is on the amount that is already tax has been paid, the tax is again charged on that amount. Like on 100 rupees from the manufacturer, when it went to the wholesaler, the tax was already paid on 100 rupees. Then when it further went to the retailer, the tax was included in that 100 rupees plus tax. So again on that 100 rupees plus tax, again tax is been paid. And finally, when it comes to the consumer, 100 rupees plus tax and then plus tax, so including that 100 rupees, again the tax is being paid. So that is called as tax on tax, which is known as cascading effect of tax. Now GST, it avoids this cascading effect on tax and is calculated on the value added at each stage of the transfer of ownership. Now the value added. In the last clipping of this video, we will understand how the value added tax is being charged as per the GST. So we will understand this later on with an example. Second one, ease of doing business. In pre-GST period, there were multiple types of indirect taxes such as excise duty, sales tax, service tax, and as a result, a business was required to register itself separately under each such act. The introduction of GST has eased the doing of business because now it will be registered and administered only under one indirect tax, that is GST. Now, in pre-GST period, when there was no implementation of GST, the indirect taxes, so you had to register under different indirect taxes, excise duty, sales tax, service tax, and so many different types of indirect tax imposed by the central and the state government. But now you don't have to do anything, you just have to register yourself under one indirect tax, that is GST. Point number 3, Developing common national market. GST is levied at the same rate on similar goods and services across all states and union territories. For example, electronic goods sold across India are levied at rate of 18%. It has developed a common national market. So GST is not different in different states or different union territories. All across India, we have got same slab or same rate of GST. Wherever you purchase the electronic goods, the GST will be same. Number 4, reduction in tax evasion. GST is administered through computer system. Electronic return filing and assessment has reduced tax evasion and compliance cost. So GST has to be paid through the electronic return, and this has reduced the tax evasion. Tax evasion means any wrong way of cheating and not paying tax on the real amount of turnover or income. So since it is an electronic return filing, it has reduced the tax evasion or the chances of people not paying tax who have got a good amount of turnover or income. Number 5, goods becoming cheaper. In the pre-GST period, there are many indirect taxes and there was no set-off of tax paid. Example, excise duty against tax collected. In GST structure, GST paid input GST is set off against GST collected. Output GST as such it does not have cascading effect and goods and services shall become cheaper. So here goods in the GST becomes cheaper. In GST, the GST paid is set off against the GST collected. So it does not have a cascading effect, and so the goods naturally or normally becomes cheaper. Attracting foreign investments and foreign investments in India was hindered because of multiple indirect taxes. GST has removed this obstruction with the introduction of one single tax. As such, it will help to increase foreign direct investment in India. So the FDI or the foreign direct investment, since it has removed all the multiple indirect taxes, the GST has removed all the multiple indirect taxes. There is no confusion of this tax, that indirect tax. So it attracts the foreign investment. Tax system becomes more transparent and regular and predictable. There are 3 types of GST. And central GST, the GST which goes to the central government, state GST or union territory GST, both of these taxes are levied on intra-sales, that is within the same state. Intra-state means the goods are been sold and purchased within the same state. For example, dealer of Rajasthan sells goods to the dealer or consumer in Rajasthan worth 50,000. Suppose GST rate is 12%. This rate will comprise CGST. The central will get 6% of 50,000 and SGST will get 6% of 50,000. So the 12% of 50,000 is 6,000 rupees, out of which half 3,000 will go to the central government and half 3,000 will go to Rajasthan government, which is the state government. Third one we have is integrated GST. It is levied on interstate sales of goods and services outside the state. It is also levied on import of goods and services into India and export of goods and services from India. So here the integrated is interstate. Like for example, dealer of Rajasthan sells goods to the dealer in Madhya Pradesh worth 50,000. Suppose IGST rate is 12%. In each case, the seller will charge 12,000 as IGST and the entire amount will go to the central government. So here in IGST, when the dealing is done to the different state from Rajasthan to Madhya Pradesh, the whole 12% will go to the central government. GST collected under IGST is divided between central and the state government as per rates specified by the government. So whole 6,000 will go to the central government, and then later on this IGST collected will be divided between the central and the state government as per prescribed by the government. If GST rate is 12%, it will comprise 6% of CGST and 6% of SGST. In case of sales outside state, it will be calculated as 12%. It will be calculated as 12% IGST. Similarly, if 18%, then 9% will be automatically CGST and 9% will be SGST. If it is outside the state, it will be IGST, whole will go as 18%. Reverse charge. Certain purchases of goods and services are placed under reverse charge. Reverse charge means that GST is not charged by the seller but is paid by the purchaser to the government and claim it as input GST. Goods and services placed under reverse charge are purchase of goods and services by registered dealer from unregistered person, payment of fee to lawyer, use of copyright, transport of goods, insurance commission, etc. So here in certain purchases, it is placed under the reverse charge. What does it mean? GST is not charged by the seller, but it is paid by the purchaser to the government and claim it as input GST. So here are the examples given for the reverse charge: purchase of goods and service by registered dealer from unregistered person, payment of fee to the lawyer, use of copyright, etc. So in the other video you will watch, you will see the further part of the theory for this chapter.